Welcome to Chit Chat Stocks. This is our weekly Power Hour episode where we talk all things financial markets on a live show on Wednesdays at 10:30 a.m. Pacific Time, 1:30 p.m. Eastern Time. It also goes out on your podcast players of choice if you like to listen there. I am one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. Brett, how are you this morning?
Doing well. We're wrapping up earnings season, but luckily we have some fun reports from the likes of Dollar Tree. Not maybe so fun for Dollar Tree shareholders, but I think it's going to be a fun one to discuss. Discount retail is in a very strange moment. And hey, we've covered Dollar Tree before. Could be an interesting opportunity, but I guess I haven't looked at the report yet. We're going to kind of do that live.
Yep, and I am going to be talking through 6 dividend growers, which are kind of right in that sweet spot for me. I've warmed on dividends in general, the whole dividends versus repurchase debate. I've started to warm up to the dividends idea, but obviously finding high dividend yields isn't always easy because it means you typically have to find an undervalued company. But we'll get more to that in a second. First, I want to talk about our friends at Public. If you want to earn a 6.9% yield for the next 4 years or more, you need to check out the bond account at public.com. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. The best part, if you act now, you could potentially lock in a 6.9% yield until 2028. In other words, no need to worry about the Fed's upcoming rate cuts. With a bond account at public.com, you can earn a 6.9% yield even as rates fall. It only takes a couple of minutes to get started, but you have to act fast if you want to take advantage of some of the highest bond yields in years. Discover how you can lock in a 6.9% yield until 2028 at the new bond account only at public.com/chit chat stocks. With that said, Brett, where do you want to start? You want to start dollar stores in turmoil?
Yeah, let's do that. But first, maybe a couple of housekeeping items. First, we dropped an episode on, well, I guess maybe I won't spoil it yet. I guess the recording will be out. Not that many people watch this on YouTube. So it is an episode called A Hidden Fintech Stock That I Am Buying. It's maybe a little tease, a remittance company that I'm buying. And I did a full hour-long research report for a podcast, and that will be in your feeds already. It was out on Wednesday. And then Thursday, tomorrow, as we're recording this, we're going to be recording a discussion with Travis Hoyam on electric vehicles, Rivian, Tesla, and the entire automotive market. He said when I sent over his notes, well, that should be a good 2 to 3 hour discussion. It should be about an hour, but we'll try to hit a lot of things there, and that'll be in your feeds next Wednesday. And the last thing, we never really do this too often, but we do like when people give us reviews on Spotify or Apple Podcasts. It's a great way to, help us grow as we're a free show. And we got this really nice Apple Podcast review. I won't read the whole thing, but they said, I look forward to the Sunday weekly power hours because I'm not able to watch it live. We have interesting perspective and helps us listeners from getting trapped in whatever investment is quote unquote trending. Well, I think we could try to do a good job of tempering expectations on the hottest sectors out there. Second, quote, I have learned better ways to look for companies and a better understanding of the fact that just because something is a high flyer doesn't mean you can't receive market-beating returns. The new small cap of the week segment is especially interesting. It has me looking for companies outside of what Wall Street typically recommends. And through this, I have found what I believe are quality companies for the long haul. All right. Sounds like that's a good segment that we should keep doing. And the good thing is there are thousands of small cap and micro cap companies out there. So we're not going to run out of any ones to do each week. But yeah, you can give us any suggestions, any, questions and stuff like that. And hopefully it'll help us drive what we should do on the show. All right.
Yeah,
I think that's it.
That. I appreciate the review, and it encourages us to keep trying different segments. The small cap of the week has been fun to do. It's forced me to look at stuff I otherwise would not. And I will say last week's small cap of the week is probably the most, I hate to use the word interesting because it's so overused. And I say that all the time when stuff isn't interesting, but the most unique situation we've looked at because of that insider buying where the CEO and founder literally picked up 10% of the company in the open market. I've never seen that before. So it was fun to look at, but I've got another good one for this week. So we'll get to that as well. Brett, are you Are you in founder mode?
Yeah, that was well, are you referencing the blog post or are you referencing the video? Because that was a
Both.
tough video for a company and a management team or a founder that I've tried to defend, but my price target might be a little lower after seeing that clip. And I will say I don't even care what, and this is the Airbnb CEO Brian Chesky was saying in that clip. I honestly don't even know what he was describing as founder mode. It might make sense, but I watched it on silent, and that video was highly concerning for reasons that people can watch the video and make their same judgments themselves.
Yeah, this is just one of my news of the week segments, so I'll just maybe skip to it right at the start here. The Paul Graham, one of the co-founders of Y Combinator, and very popular figure in the venture capital realm sphere, had a blog post this weekend where he talked about, and I guess coined the term founder mode, and says it's kind of the right way to grow a venture. And I actually kind of this got blown out of proportion because it becomes a meme typically, but basically Graham thinks founders should be involved in the minutia of running their business and not become like the conventional manager where you just delegate different roles and functions to other managers. So I agree with that. I think founder mode, especially at the certain stage of a company's life cycle, you really need someone who's very bought in and dug into the product and understands, like it says, the minutia of running a business. However, there was also a speech that Chesky gave, and then there was this video. I don't know if it was a podcast or what was happening, but
Probably a podcast, yeah.
he looked like he was, I don't want to make any assumptions.
Yeah, just make your own assumptions watching the video. Yeah, we definitely don't want to make those allegations
he
publicly.
looked very fidgety and just really excited, I guess you could say. And it just coincided with the whole founder mode thing. So yeah, I recommend watching the video. It's pretty funny to watch. But yes, so that knocked down your price target.
I was gonna ask you. I think for Airbnb, and I'm not sure. I know that they have that weird tax thing that's inflating their net income. So on a normalized kind of EBIT, I was thinking maybe something around 20 is what I would be interested in. Maybe that video itself knocked it down to 15. I think maybe that risk, I want a trailing, normalized earnings multiple of about 15 before I buy. I think that might have sent it down quite a bit. That video was, and I wrote about this on Sunday for our newsletter, where management teams can be guilty until proven innocent in our light, because we're just trying to have as high standards as possible for the portfolio companies we have. This is definitely a major. It's hard to call it a red flag because
it's working.
Yeah.
It's producing results for him.
Yeah, exactly. We don't have any context there, but I would maybe almost in between a yellow and red flag. It was not great. I would say that it tempers my expectations a lot, or maybe not tempers my expectations. It raises my caution levels with this company.
Yeah, we don't need to go too long on it. I recommend anyone who doesn't know what we're talking about, just go ahead and look up the video, probably Brian Chesky. I don't know what you'd title it. Clip, Brian Chesky.
Founder mode.
I founder mode. I bet it's up there. Bet it's up on YouTube right now. I want to go through. I kind of want to kick things off with my dividend growers. Thoughts?
All right, yeah, go right ahead. It's perfect timing. I think we also had a question from Tyler on Twitter that relates to this, about in a falling rates environment, would you rather own stocks or bonds? I think I might just answer that. For us, we're so young that we solely focus on stocks, but for someone that is older, maybe the 50s, 60s, or even older, you might want to have bonds instead. But we're not going to really talk bonds on this show, although our sponsor does have a nice new product that you should definitely go check out. But yeah, why don't you go through these? These are probably, I think they've been doing quite well because people are signaling that interest rates are going to fall, and this is where you can search for yield.
Yeah, and I actually I've never really given that much consideration to fixed income products until we actually had that bond account launch from public, and I'm definitely considering just moving some of my cash position there. But anyways, yes, let's talk dividend stocks. So for context, I was always on the fence about, like, people always talked about how they love dividend stocks, and some people get very married to the idea that a stock has to pay dividends for them to be interested in. And I get it. They like the continuous payments. But I always had this kind of purist idea that repurchases are better. It's the exact same form of capital allocation, essentially, or capital returns, and it's more tax advantaged. However, I've now kind of hopped over the fence into the dividend camp, where I appreciate companies having to pay a dividend because it forces them to work with less cash. It forces them to have that recurring payout. If you have just an open repurchase authorization, you can always pull back on it if you want. You can say, we saw other areas to invest that capital this quarter, whereas I kind of like the consistent capital returns. So
we're going to buy a cannabis company for $10 billion.
Yeah, and if you don't know what Brett's referring to, that was Altria, who they actually had the dividend mandate, but they could have been buying back stock, and instead they invested aggressively, and it just goes to show. It was Altria you were talking about, right?
Well, it's kind of theoretical, I guess.
Oh, I was thinking about Juul acquisition, but otherwise.
Yeah, I think that's just kind of a good example of, targeting some very risky cannabis companies for your capital allocation instead of a dividend. Maybe it'll work, but the more consistent thing to do for your shareholders is to return that in a dividend.
Yeah. So anyway, I'm growing more and more fond of dividend payers. The difficulty for me is I don't know. I don't want to just reach for yield. I don't want to reach for the highest dividend yield possible, because typically, and I say this as it's generalizing, and there might be exceptions to the rule, but if you have a dividend yield that exceeds the current treasury rate, what you can get with 10-year bonds, it's probably a company that's not expected to grow its dividend very much. And so I went through and I looked up, just did a screener for companies that have grown earnings over the last 5 years, and it's just literally grown earnings. It doesn't have to be like a certain rate. It's just more than 0%, and grown revenue over the last 5 years, and have a current dividend yield of more than 4%. It's tighter than you'd think. There's a lot of REITs and stuff like that, but if you strip those out, it's really tighter than you'd think. And a lot of the most attractive looking ones were more in the 4% range, the 3.5% to 5%, where it's paying a good dividend. Investors have soured on it a little bit, but it's still a growing business. And so I'm going to go through 6 of those that I find pretty interesting, and the ones that kind of caught my eye. So number 1, this is my largest holding, so I guess no surprise it caught my eye, but Philip Morris, they pay a 4.2% dividend yield as of when I wrote these notes down. May have changed a little bit today. I don't know. It used to be a much higher dividend yield. The stock has kind of soared lately. A lot of the reason for that is that they have kind of returned to growth. Volumes are growing for them again.
Well, I would say it's this summer. It's because of interest rates, but
yeah,
they've been growing the last few years, so that hasn't changed.
Yeah, for a while, the aggregate volumes were in decline. I'd say over the last 5 years, it was either flat to down, the aggregate volumes. But as the mix shift has moved towards reduced risk product, you're starting to see more and more volume.
Yeah, maybe I'm assigning too much.
You could see that coming.
Yeah, maybe I'm assigning too much intelligence to Mr. Market that everyone could see that, but I guess a lot of people just look at headline numbers, so who knows?
Yeah. But yeah, 4.2% dividend yield. I expect this is a business that can grow their earnings in double-digit percent range for the future, foreseeable future at least, but kind of remains to be seen. I've talked about them on the show a number of times, so I'm not going to go too long on them. Second one here is a name I have followed, but not really looked at that much. Like I've just like vaguely seen it throughout. So it's PACCAR. They design and distribute commercial trucks and parts all over the globe. Then
Shout out Puget Sound area. Did you know they're from Seattle?
You know what? There was a point when I was looking for jobs and PACCAR had like tons of job listings. So that would make a lot of sense. I did not know
Sneaky
that,
big
though.
company, yeah.
Yeah, they sell primarily through independent dealers. Some of these are familiar names to me: Kenworth, Peterbilt, DAF. I'm not really sure what DAF is, but I know the other ones. 4.6% dividend yield, roughly. However, they kind of have a wonkier dividend payout. So if you can pull up PACCAR on FinChat.
Okay, yeah, I can try that. I was pulling up one of the next ones, CME Group, but I can do PACCAR as well. What do you want to look for?
Go to the dividends tab, which is at the top on the company page, and if you have any trouble finding it, share your screen.
What is it? What do you want? Dividend per share, dividend yield?
No, I just want the actual payouts, and you'll see what I mean with like the quarterly payouts if you scroll down. So it's like not a lot of companies will pay out like the same amount each quarter and then increase it and keep doing that. But PACCAR does it really weird where they special dividend, I think like once every 4 quarters, essentially. And so you have to look at it on a trailing basis, because if you just annualize the latest quarter, it's going to look a lot lower. But PACCAR actually does a good job really returning capital to shareholders. You're sharing your screen there. So if you scroll up to the top, Brett, and go to dividends on the right, yep, and then scroll down, you'll see that it goes 30 cents a share, 30 cents a share, 27 cents a share. These are, I'm working backwards as quarters, and then $3.02 or $3.20. It looks like every 4 or 5 quarters they pay out a big kind of chunk of a dividend. So it's a little inflated here because they paid out a big one 4 quarters ago, but still good capital returners, and they have grown earnings at 16% a year over the last 5 years. I'll go a little faster through the rest of these. Third one, I don't have quite as much interest in, but CVS Health Corp.
Nope. So 0. It's a 0.
What don't you like about it?
The visiting them in cities on the west coast of the United States, they look like a Call of Duty map.
Yeah.
It's not good. It's not good at all. It's really, I don't know why anyone would buy these.
So here's the thing. I've seen CVS tossed around as kind of like a really bad business, and it could be, but the metrics, like it's a growing business. Revenue has grown at 10% a year over the last 5 years. Earnings per share 9%, and they pay out a 4.6% dividend. So yes, I realize that it's not a great consumer experience. I've experienced that here in Seattle, but there's the potential for returns here.
Too hard pile for me.
Okay.
I don't see why
it's
this
also in the
needs
healthcare space. So
yeah, they have some. I think they own something besides the pharmacy now. Like they moved up the chain. I'm not exactly sure, but I don't know why. I don't know why this company needs to exist.
All right. I'll skip to the next one here. CME Group. CME is the world's leading digital derivatives marketplace and clearinghouse. They facilitate the trading of futures and options for like tons of different markets. And this is kind of, when you look in like the wide moat list for a lot of companies, or for a lot of like funds, you see any wide moat list tossed around, CME Group is one of them. So they've got a almost 7% dividend yield right now. They have grown revenue at 5% a year over the last 5 years, but
check out this free cash flow per share.
Yeah.
Not bad. 11.6% CAGR since 2014.
Yeah, I'm not sure what's going on there with the half chart, but I'll send a message to the team there because it's leaving all that white space. Anyway, Yeah, CME Group's probably one of the most attractive ones on this list. My fifth one here, and we're working up in terms of dividend yield. That's kind of how I'm ranking this list. And I guess I'll just maybe blend these two segments together because this is also going to be a little spoiler alert here. My small cap of the week, OTC Markets Group. OTC Markets provides critical infrastructure that broker dealers rely on to facilitate trading on over 12,000 US and international securities. Basically, they operate the OTC markets. So I've got a quote here from a Value Investors Club write up, and there was also another good write up on Yellow Brick as well. Says through OTC Link ATS, which not really sure on the ATS acronym what that means. It says the company connects a diverse network of broker dealers that provide liquidity and execution services. Overall, OTC Markets generates about 85 to 90% of its revenue through a subscription-based sales model. This is the OTC markets. Typically, when you're a market operator, it's a pretty resilient, durable business. They are somewhat cyclical because IPOs help them. And so they've actually been growing despite little IPO activity. And so pretty impressive results. I've got a chart here pulled up on our notes page, but it's 10.3% revenue CAGR over the last 10 years. It's been just steady growth up and to the right. I like exchanges, marketplaces, whether it's OTC markets, derivatives like CME Group, whether it's the New York Stock Exchange, which is owned by ICE. What's the full name? I think the ticker is ICE, but I can't remember what the
Intercontinental Exchange Group, something like that. And if you look at, I pulled up OTC markets and I'm sharing this here, but for the listeners, earnings per share and free cash flow per share have both grown at over a 10% compound annual growth rate since 2014. And as you can see, you're right, it can be a little cyclical. That IPO period in 2020 and 2021 gave them a boost, but maybe I would have to investigate this further. We're at a somewhat of a trough. It's weird saying that because the market seems like it is potentially in a bubble, but there have been so few IPOs. So that's such a conundrum for me right now, is what, like, identifying what sort of normalized earnings power this company has. And maybe you just have to be conservative, take a long-term view, and be confident in that moat. And you can see with, like, historically the durability of these exchange businesses. There are clearly competitive advantages if you run them well. So maybe this is one to check out.
Yeah, and if you scroll up there, Brett, it'll show the market cap, which I believe is just over 577 million. So under $1 billion market cap, and I find it quite rare to find a small cap with like a true moat, like true network effect, whatever.
Been around for a long time, yeah.
Yeah, durable. But OTC Markets Group certainly is one, and they don't really get a lot of interest from the investment community. It seems like they trade at 17 times EV to EBIT. So reasonable valuation, especially considering that they grow pretty consistently. And keep in mind, you were mentioning that it feels like we're kind of in a bubbly period with some of our valuations right now. The companies listed on the OTC markets are not really where the bubble exists.
Exactly.
It's kind of more centered around big tech.
Maybe people trade down, when if the bubble pops, hey, we can't really list you on the NASDAQ, but we got these nice pink sheets you might want to be interested in.
Yeah, and then it actually pays out a 4.7% dividend yield as well. So you're getting those payments along the way. I think they have a founder, sort of owner operator at the helm as well. So I think there's a lot to like there. Highly recommend checking that one out. That is my small cap of the week. The ticker is OTCM. Then the sixth company is one I imagine most Americans at least will be familiar with. It is the United Parcel Service, ticker UPS. UPS, most people know what they do. They provide letter and package delivery, transportation, even logistics services as well. And there's some other services that they have in there also. They've added stuff over the years. And they do so in the US as well as internationally. And if you actually pull up their segments and KPIs, Brett, they have like number of parcels they're delivering, price per parcel. And it's over the last couple of years that they lost some big business with Amazon. I can't remember when that was. And so there was a big decline because of that. But it's still a fairly resilient business. It's certainly hard to replicate. You have to have tons of CapEx in order to do it. That's why Amazon's one of the few that has actually been able to.
I'm pulling up daily packages. Yeah, it's barely above 2019 levels. And yes, I think, sorry to interlude there, but I wanted to just explain the chart I'm sharing here. It's definitely one where you have to identify is, it's an Amazon risk. They're entering your business. They're competing with you now through this vertical integration. And you have to ask, is this a Bed Bath & Beyond or is it a Best Buy? If it's Best Buy, you might make money.
Yeah, it's, you would think this is a wide moat business, and it's trading at one of its highest, pretty much the highest dividend yield it has in 10 years, 5.1%. So if you think this is a business that can actually grow at all, you're probably going to get a decent return from here.
Yeah, I like it better than CVS for that Amazon risk. I think CVS is likely a zero unless they get some crazy good management team, because there's nothing working in its favor. Real estate's too big. Sector's moving online. You have competition from all over the place from any of your profitable segments where like you're even getting competition from DoorDash and Uber Eats, right? So yeah, I don't like it, but all right, that segment's been going. We went plenty long on that segment. Let's move into something. People want to talk Celsius and Dollar Tree, two stocks that are falling a lot. Maybe we hit some of those.
Real quick. Of the 6, which one did you like the best?
OTC markets.
Okay.
And then second, CME Group. CME Group might be a bit too complicated for me. Might be in the too hard pile because that's just a tough. Derivatives are hard to understand, like who's winning, who's not. But OTC markets, I can understand that one. And you could see, and theoretically, without there's a moat there. There could be a moat there, but obviously I'd have to investigate further.
Yeah, surprised it's not talked about more. But anyways, all right, let's talk. You want to start with Dollar Tree and Dollar General or Celsius?
We got a comment on Celsius. Someone says, Celsius, what is happening? 3 exclamation points. I have no clue why it's falling like crazy. I think this does indicate that I should do my next stock research report on Celsius. There's a lot of interest in this company, and I do think it's an interesting company as well. Maybe I'll pull up the stock. I have been doing a little tweet quote thread of, whoa, I did not see that. Down 10.7% today. Well, that is a big drawdown. Yeah, it was down to like 37 yesterday. Drawdown 66% from its highs. I wonder what caused the drop today. Maybe some sort of analyst downgrade. Not exactly sure. But I know why it's been falling this year. And it's because the energy drink market has gotten, shall I say, more competitive. Say Monster and Red Bull are kind of counter positioning themselves versus Celsius, where Celsius started out with a great counter position versus Red Bull and Monster with the sugar-free stuff, focusing on fitness. Now Monster and Red Bull are leaning into that a little bit more. You also have the fact that Celsius sold too much inventory to Pepsi as they stocked their new distribution deal, and that led to a huge surge in revenue growth in the first parts of that deal. But now they're working through that, and that's why revenue growth has stabled off a bit. And then there has been a ton of alt data. I think I'm just seeing screenshots online of Celsius market share stagnating at about 12% in the United States. So when I add that all together, you can see why people are nervous about the stock. And if you look at why don't we pull up a forward earnings ratio? I guess I don't have to pull it up. I just want to find it. Forward valuation, PE. I'm still seeing 31. So the stock it's not like it was trading at dirt cheap. It was at a PE of something like 50 or even 60 earlier this year. If we look at those forward earnings multiples, and when you buy a stock like that, you have to be either ready or expect honestly a 50% drawdown, because that can happen even if you're confident in the long term, durable growth, dominating the category, a great stock to own. Even if you're confident in that over the long term, a stock that starts out at a very high valuation can go through pretty extreme drawdowns. And that's just something you can't be afraid of embracing if you're going to buy a stock like that. Because if you aren't, and you're like, I'm going to buy a 60 times PE stock, and it's never going to go through a drawdown. It's just going to keep going up and up and up forever. You're guaranteed to be disappointed. But I want to say Celsius, I don't know why I dropped again today, but wow, looks more interesting here, doesn't it, Ryan?
It looks like Pepsi said something about it in their report.
Probably about it's slowing down or something like that.
Yeah, I'm looking through here. It says, sorry, I'm doing this research kind of live.
Well, here's whatever they say. If you are companies always go through short-term stuff like this. It could be a quarter, it could be a year that this happens. If you are confident in the brand, which I'm not sure about yet, if you're confident in the brand durability, if you're confident this can be the third energy drink player along with Monster and Red Bull around the globe, hey, it looks bad right now, but maybe it's a buying opportunity. I would say, I don't know. I'm going to do a full research report on it for the month of September, but it's interesting for sure. And you maybe just to go back to some basic stuff, on days like this, if you own a stock in your portfolio and it goes down 10% and it's in a 70% drawdown, just stop logging in at that point. You have to trust that the business is fine. And if you're confident in the business, you got to let it play out. And if it doesn't work, hey, look, hopefully it wasn't 100% of your portfolio. But I did see yesterday and this made me so scared to look at the stock. Someone said that they had a portfolio that was 33% Celsius and 66% lemonade, and that was their entire portfolio. So that made me think there might be some lower, the price might move lower at some point. I didn't think it was going to be the next day, but that was some fortuitous timing.
I would have a hard time sleeping at night if that were my portfolio, but to each their own. I will say it's not like Celsius alone is being hurt here. The energy sector overall has had a slowdown, and there's actually our friend Alex Morris had a wonderful write-up on both Monster and Celsius and the energy sector broadly. And as part of that, there was the co-CEO of Monster came out in the conference call for Q2, and he said, historically in the United States, we have only seen volume declines during the financial crisis and during the COVID lockdowns. The current situation is relatively unprecedented. So they can't really explain why there's been this secular slowdown or this slowdown across the industry. But Celsius is still a market share taker. As even though they're growing slower, they're growing quicker than their peers still. Now, the market share growth isn't as quick as it once was. And this is what happens also when a company that's growing triple digits slows down. Peter Lynch talked about this in his book, which is that's really the situation you don't want to be in because expectations will change fast. And looks like Celsius is in what now, 70% drawdown?
Give or take, yeah, something like that. So pretty rough. But again, look, this is the time. Here's what I'll say. It's not going to be the end of the world if you keep holding on to this thing and then take a tax loss if it's a total loser. But if you sell now and it's a big winner, you'll the risk reward. You know what I mean, Ryan? There's nothing that has been definitive within what's happening with Celsius to say that the company is way worse than it was 2 years ago. But
I'd say if anything, it's better.
Exactly.
They were going through accounting issues, and I think they had internal control weakness in their internal controls. So yeah, it's definitely a more professional business today.
Yeah, and someone in the comments said that I think reference to it being a small part of the portfolio that they have 5 stocks in their portfolio, and I would say if you have 5 stocks and you have a large position in Celsius, and this drawdown is making you stressed. emotional, it's really causing you pain, it might you might want to research portfolio diversification. I think that would be my personal finance tip of the day. But I think that's enough Celsius. You want to talk Dollar Tree? Very interesting report as well. And I woke up and saw the stock down 20%. And I was like, wow, what is going on? So yeah, why don't you take us through some of the numbers?
Before we get to that, I do want to mention one of our sponsors and someone I already mentioned earlier, which is Yellowbrick Investing. Join yellowbrick.com. It is one of the best ways to find ideas on the internet. It's an aggregator of the best stock pitches. We just talked about Celsius and we're about to talk about Dollar Tree. I guarantee if you just go to joinyellowbrick.com, type in the ticker for either of those companies, you are going to find a high quality write-up from somewhere across the internet that you can read and get up to speed on the idea. They track thousands of blogs, newsletters, fund letters, podcasts, even smart Twitter accounts as well, and brings all the ideas into a single place. So if you go to joinyellowbrick.com/chitchat, you can get a discount as well on the paid plan, which gives you access to investor returns and also gives you the most recent ideas instead of a month delayed. But I highly recommend just checking it out. It is a repository of high class stock pitches. Dollar Tree, well, I did not read the whole report, but I went through some of the segments and KPIs. And I guess the thing that surprises me, yeah, it's down 64%. Wow. Drop that
from drawdown of 65% basically. And the drawdown started at the beginning of 2022. So that's been a rough and extended drawdown for shareholders.
Yeah, and I guess the thing that surprises me is that Dollar Tree for me seems the stock sold off on Dollar General's report because Dollar General had a rough quarter as well. And I kind of thought that was misplaced because I don't think Dollar Tree and Dollar General necessarily attract the same businesses. We went through and did a deep dive on each, or a not so deep dive as we used to call it, on each of those businesses. And Dollar Tree was much more, felt like, I don't want to say discretionary items, but if I remember correctly, it was attracting a different customer. It was a lot more kind of arts and crafts type of items as opposed to like grocery and critical like necessity type items. Am I summarizing that correctly? Is that kind of what you remember from that?
Yeah, I do remember that as well. And they owned Family Dollar, which was more of a direct competitor to Dollar General that was struggling a lot. But Dollar Tree is more of a traditional dollar store that's not going to be the durable consumables, as they might call it, which is food, stuff like that, household items that you need. And it's more of, oh, this is a cool knickknack. I need to find a discounted birthday present or something like that. You can go there, kind of do a little bit of thrift shopping style. And I'll look at, so the people watching on video can see this chart here that I'm sharing from our friends at FinChat. Look at this customer traffic chart, Ryan. July of last year, it grew to 9.8% year-over-year growth. And each quarter, it's gone down essentially. And last quarter that ended in July, we only saw 1.4% growth in traffic. Obviously a decline isn't concerning on its face, but if you look at this, do you think this is just a tough comp in traffic?
Maybe. I'd be interested to see the commentary from management. I guess what this highlights to me is it makes Walmart's quarter that much more impressive. Because if you think about the exposure to the customer base as sort of similar, which I would say between Dollar General and Dollar Tree, it's probably somewhat similar.
Decent Venn diagram, yeah.
And they've put up 40 quarters in a row of positive comps, and they continue to accelerate their comp store sales. I think it just goes to show the economies of scale at Walmart. The other part is there isn't that much Family Dollar and Dollar General. There's some geographic overlap. Not as much with Dollar Tree, like you mentioned. It's more knickknacks, more urban areas, if I'm not mistaken. So, yeah, I wouldn't lump the two together. Part of me is just unattracted to these businesses. I don't know why, but it just there's something that doesn't really pique my interest about either of these.
Yeah, buy Amazon instead. That's kind of what I think when looking at any retailer. Where I'm very, very confident in that platform. These ones I kind of have to make a lot of assumptions. All right, what do I have to bet on? Are they going to be smart with their retail footprint? Is there a threat from Temu? Like, is that legit or not? I don't know. We have a question here that relates to this. Do you guys have any thoughts on the idea of a K-shaped economy where the poorest Americans are struggling while the richest Americans are doing okay? I think that is showing up a lot in earnings reports. Look at American Express, thriving. Look at Dollar Tree and Dollar General, not so much.
Doesn't that always describe the economy, though?
I think people argue, yeah, a bit. But what's interesting is that 2021, 2022, 2023, we actually saw for the first time in a long time the lowest 25% of wages were growing the quickest. So I think that maybe helped some of these companies, and now that's more, quote unquote, normalized. I guess none of it's normal. It's kind of just how the economy is working together. There's also arguments I see that these are the first indications of a recession. And if things get worse, then everyone starts to struggle. All the cohorts start to struggle except for the extreme, 0.1%.
I think I would take the flip side of that, which is we have seen consumer spending grow really, and discretionary stuff grow really quickly following COVID. You look at the comp sales at companies like McDonald's and Starbucks and the dollar stores, and trying to think of some of the other ones that had big headline numbers coming out.
The home retailers, Home Depot, Lowe's, right?
Yeah. And then you look at it, now they're starting to revert a bit. I would say that's pretty healthy consumer behavior. Like, if they're no longer spending on some of the discretionary stuff that they don't need, while we're not seeing like a sharp decline in some of the necessities, like Target, for example, Walmart, they're still reporting relatively strong comps in their durable or necessity type goods. I think that's just fine. I would not say like, oh, that's very concerning if some of the discretionary spending pulls in a little bit. Yeah, those stocks will get hurt, but
more of a normalization. And
that's way healthier than some sort of abrupt cutoff in. I would be more concerned if the grocery providers or the big grocers were saying like, yeah, we're seeing -10, -20% comps or something. Then that's a concern.
And it's strange because Dollar General is supposed to be counter-cyclical. When consumers are struggling, people are supposed to trade down. So maybe that K-shaped recovery is playing out. Hard to tell. I would also say that when you look across a lot of the financials companies, and this could obviously age poorly because things can change on a dime, loans are performing relatively fine. So don't know. Yeah. Dollar Tree might be interesting. I don't know why I don't like it, but it might be interesting. It's cheap, and they're potentially spinning out Family Dollar. So that could be a nice little catalyst.
Yeah, I think we have seen tough quarters out of a lot of companies in the retail space. Lululemon, Nike,
Starbucks, McDonald's. Yeah,
you name it. I think delinquency rates at the big banks is a much better indicator for economic health than Starbucks traffic numbers. So, and we're not seeing any concerns there, like you said. So it seems healthy to me. I would not be too worried about recessionary fears.
Yep, I agree. All right, and you saw that KPI chart. Make sure you go check out finchat.io/chitchat. New version came out, I believe, today, Ryan? Is that correct?
Slated to come out today.
Slated. Well, it's coming out very soon, and there's just wonderful charts on there. So go check it out. finchat.io/chitchat. Link in the show notes. Get a discount on your paid plan. Ryan?
And while we're talking about one of our sponsors, we should also mention another friend of our show, Public. Again, heads up, The time may be running out to lock in a 6.9% yield at public.com. When you invest in a bond account, you can lock in your rate until 2028, but with potential rate cuts on the horizon, you might want to act soon. Discover how you can lock in a 6.9% yield until 2028 with the new bond account only at public.com/Chit Chat Stocks. What are the news items you want to hit this week? Supermicro, they responded.
Yeah, we can do Nvidia first, not the earnings. I know everyone talks about that ad nauseum, and then we can do Supermicro Computer because I think their letter was, let's tease it, interesting, But there was the Nvidia earnings watch party. How do you feel seeing that stuff, and how Nvidia earnings felt like the Trinity test from the Manhattan Project?
I was a fan of this. I saw that there was this watch party for Nvidia's earnings, which it's outrageous, but I think that'd be kind of fun to not more as a bystander. Still, it's kind of cool. That's fun.
But
I
think it would be fun to go to, but it also, I think, is top-ish behavior. And a lot of people that were around during the dot-com bubble said they have the same feeling as Cisco.
I feel like more people probably attended that watch party, knowing it's top-ish behavior, kind of ironically going to that. Not
maybe. But the company is still at a market cap of $2.6 trillion. So clearly someone still wants to own it.
Yeah. I mean, yeah, the results are still incredible. I kind of just say fade Nvidia. The hype, I kind of shrug it off because the results are really, really strong. And you could, if you believe that.
But so were Cisco's.
Yeah.
And they overbuilt for 15 years. Built way too far ahead from what the demand was.
Yeah. And this is around the dot-com period?
Yeah.
So you think this has
It smells like Cisco.
Do you think it has
I don't know if it tastes like Cisco, but it smells like Cisco.
Do you think Nvidia's results actually have bearings on the economy?
That's a good question. Yes, because spending, I think the wealth effect is real with how much people are tied into index funds, the 401ks, target date funds. Everything is tied to the S&P 500. And Nvidia is a big part of that. So yes, I do think it has an effect on consumer spending, consumer optimism, and that wealth effect. Now, how large is that wealth effect? I'm not so sure, but I have a big hunch that it is real. And it especially today compared to 40, 50 years ago, with how our financial markets are set up, you don't have the pension. You have the 401k and the index fund. And that's what you see on your bank account or on your brokerage statements.
That's fair. I still think a watch party for my company's earnings would be kind of fun. I do feel like you'd get there. Maybe a bar would have it on the screen, whatever, almost ironically, and probably only in Manhattan. But it would be super underwhelming.
Yeah.
There's no point where you cheer, there's no touchdown or whatever, home run. It's just something it came in slightly better than expected. The stock hasn't really moved at all. Oh, it looks like it's going down a little bit. Okay.
Yeah, no, I think it'd be funny. It's all right, we're connected to the live stream, and then you just see some IR person go, all right, now our safety is close, whatever the safe harbor disclosure. Let's go through. None of this is financial advice. These are projections, blah, blah, blah. And then you get some really bad audio. So, yeah, I am one that never listens to conference calls unless I really want to hear a tone of the management team. Just read the transcripts. Just read them. Saves you so much time. All right. You want to look at this Hindenburg response?
The response to Hindenburg? Yeah.
Sorry. Yep. Thank you. Supermicro Computer. There was a short report last week from Hindenburg a lot of damning allegations. Now, none of this has been proven in court, so we should all say these are just allegations. But, and I'm stealing this from, since we're getting ready for the NFL season, I listened to the Bill Simmons podcast, like I think a million other people in the United States, and he had a thing about what teams have a bad odor coming out of them, where something doesn't smell right. And I thought that could apply with companies and stocks. And I think Supermicro Computer, it's stinky, I would say. But here's what they said. So in response to it, they had a letter. I think it was framed as putting like a letter to their customers, but they posted as an SEC filing. And one little indicator I like to look at for whether a company actually wants people to read what they put out is if they put out the SEC filing in the 8K, but they do not list in their news releases tab. And this is what happened there. So I don't think they actually wanted people to read this, but they said, quote, "You may have seen our recent announcement that Supermicro will be delayed in filing its annual report for the fiscal year ended June 30th, 2024, and separately, a report published by a short seller. In terms of our annual report, the audit committee of the board of directors decided to delay the filing and, as we shared publicly, has also formed a committee to review our internal controls and other matters. The board committee is working diligently on this thorough review. Separately, you may have also heard about a recent report from a short seller hedge fund that contains false or inaccurate statements about our company, including misleading presentations of information that we have previously shared publicly. We will address these statements in due course. As you may know, short seller reports are designed to drive the stock price downwards to serve the short seller's interest to the detriment of the company's shareholders." Now, rating a 1 to 10, how for or against are you of buying Supermicro Computer after reading this letter?
In terms of response to a short seller report, I would give this, and 10 being Reed Hastings back in the day when they responded to one, because I thought that was as perfect as it can be, versus who was a really
Enron.
Yeah, maybe Enron yelling at the guy on a conference call. I would give this a 3 or 4. I didn't mind that they approached it kind of customer first, like this isn't going to impact how we run our business, that kind of thing. That's okay with me. The fact that they didn't actually address any of the real allegations, that's usually a sticking point. That's the first thing I look for is, do they address any of the specific allegations?
Right, not just say there's misleading statements. Well, yeah, one of the things might have been misleading, but there was 20 others, and are those correct?
Yeah. I'd give this a 3 or 4. It doesn't make me any more confident.
No, I thought it was fairly weak. Definitely red flags across the board. They kept highlighting something like our liquid cooling technology is ready to ramp. And I felt like I was listening to the Wizard of Oz. Like, don't listen to the man, or don't look at the man behind the curtain. Don't look at this stuff. We have an audit committee looking at our annual report, and we are finding no issues, even though this was the same people that had an accounting scandal in 2018. Yeah, I mean, Supermicro Computer, the quintessential stock of a boom period that you want to avoid. It's the one that just has the name in it that makes a lot of sense. Supermicro Computer for the AI and semiconductor boom. Like it is pretty obvious that this is a really risky stock with maybe a lot of upside, but just so much downside potential. It's just read financial history. These things pop up time and time again.
Yeah, you're thinking there was exactly what I was thinking. Our committee is reviewing these allegations. Our committee is very confident that we didn't have anything wrong with our annual report. And that committee is the same one that was rehired after 3 months after being charged by the SEC for significant accounting violations. So yeah, putting the term committee on anything makes it sound like it's a team really working hard to do it, but it's the same people that committed.
Yeah, it's like when Boeing was like, yeah, Boeing, we're forming some safety committees with some people that they don't know anything about manufacturing or engineering, but we're confident that these ex-McKinsey employees, that they'll really lock things down for us. They got a game plan. They're going to work through this game plan and form some stuff.
They have
Okay,
4
great.
slideshows ready to go.
Yeah, we got a lot of slideshows. We got a lot of 21-year-olds that have stayed up all night working on slideshows. It's great. Do you want to talk about what was maybe one of the most interesting little tidbits from a random news article that I saw pop up online? And I'll read the quote for you here. I think you probably saw it because I went a little bit viral. It said from a Financial Times article for OpenAI, investors are currently required to sign up to an operating agreement that states, quote, it would be wise to view any investment in OpenAI's for-profit subsidiary in the spirit of a donation, and that OpenAI may never make a profit. Now, is this a company you want to pour $100 billion into, Ryan, or not?
Yeah, it's really, I'm rolling my eyes for anyone that doesn't watch the videos. I just think Sam Altman, I think the team at OpenAI is just, they think their mission is more noble than it is. And it's what they are doing is really powerful stuff. And you know what? People make comparisons about OpenAI and sort of early days of the internet. I think there are certain analogies you can make where they are powering a lot of more domain specific AI applications. So, for example, FinChat built on the OpenAI architecture, and it addresses an actual need. And not that ChatGPT doesn't, but it addresses a more specific need. There's the same thing. Thomson Reuters has an AI project called Co-Counsel, which helps with like legal offices. It's AI for that. Once again, put on the OpenAI architecture. So they're doing something that could power a lot of future businesses.
Usage is high, yes.
You do not need to be a nonprofit to do that. In fact, I would I think in most cases, I kind of stand with Bill Ackman on this because he's made this case before. He says, I think oftentimes for-profit businesses can be much more influential and impactful than nonprofits. And for me, that's there's nothing wrong with being a for-profit business when you build something this powerful.
Yeah, exactly. You generate the profits, you give it back to your shareholders, and they can do whatever they want with it. They can build their whole charity, donations, whatever you want. And it's kind of like when we saw in the 2020, 2021 SPAC nonsense, all these companies coming out and bragging that they're a B corporation. And they're like, well, we're going to donate some of our profits to charity. I'm like, great. I'm never investing in you. So good luck. Good luck with that.
If you drive a car, if you are the CEO of the company and you brag about being a nonprofit and you drive a car that costs more than $100,000, you have lost any sort of credibility for me. Because the idea is that you're this person that gives back and you're not this horrible consumer, like
exactly
taking all the whatever, like the nice things in life. You're lying.
Yeah. Okay. Well, what do you think about this in general? Like that's
dumb.
No, sorry. What do you think about OpenAI in general right now? Seems like ChatGPT is having another little boost of usage. It seems like they keep growing, but the expenses have got to be high. And we're seeing rumors about a new funding round that needs to be very, very high.
Yeah, it has probably high capital intensity, a lot of compute costs.
Yeah.
But, you know, I just said it. I really do think they are positioned well to power a lot of to be a really good B2B company, like to power the language components of more domain specific AIs, which is like that's a really nice place to be in. And they have pricing power. Like it's not easy to switch your LLM that you're built on. So
right. Makes sense. That's intuitive.
Yeah. So I think it's a promising business, probably very costly to run. I bet people are I don't believe some of the valuation, or I don't think some of the valuations that they are putting out there in the world, the $100 billion, are justified yet, but we don't have that much data on them. So how can we really know?
Yeah, that's true. That's true. There's a lot of variables at play, though. You have the computing cost. Okay, how does that shake out? You have supply on that side. You have the competition. You have so many things that, yeah, maybe Microsoft, it won't affect Microsoft, I don't think, unless they pour $100 billion into this company. But I gotta say, I don't necessarily understand the risk reward of Microsoft in this case, but maybe I'm looking at it entirely differently. From what I mean is pouring all this money into this one company and not trying to buy it yourself.
Did you see what Salesforce or Mark Benioff said about Microsoft's AI efforts?
The Copilots, it's just a narrative and it's not actually that useful. Yeah. Well, I think I could bet on that. It's a Microsoft consumer product. So, or sorry, like those products are never that useful. It's the same thing. It's Excel and Word. That's what people use.
Yeah. Also, I'd be surprised if Salesforce is having way more success in AI either. Like, I bet people are a little reluctant. I don't know.
It's kind of like
stupid stuff as well.
Yeah, I'm not necessarily sure that they have the solution everyone's looking for, but hey, all right, we're going over an hour here. Let me close things out. Let me hit the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. These episodes go live Wednesday, 10:30 a.m. Pacific, 1:30 p.m. Eastern Time on the Chit Chat Stocks podcast YouTube page. Thank you for everyone that joined us live. We really appreciate it with all the questions. Hopefully we had a good discussion, and we'll see everyone next time.